February inflation climbed to 3.2%. Core CPI up 3.8% on the year. Our next guest says, although core CPI was hotter than expected, the details are encouraging. To break down those details, investors should pay close attention to. Let's bring in Kevin Gordon, Charles Schwab Senior Investment Strategist. Kevin, good to talk to you today. So give me the silver lining on the back of this if it is about ultimately bringing inflation back down to that 2% target.
Yeah, I mean, I think the silver lining was more so that you didn't get a confirmation that some of these blips and some of these spikes that you saw in January were going to be continued. So much like the jobs report for February, you almost had a canceling out of some of the concerns that started to pop up in January. Same thing with CPI. So even though core looked a little bit hotter, as you were mentioning, if you look at some of the details, you still had, goods deflation for a good chunk of that part of the economy. And then even for some services, you started to see it rolling over. So when you look at the contributions from some of the areas of services like airfares, for example, which were up a considerable chunk. Yes, those were large drivers to the upside for a core metric, for CPI itself. But I think that, broadly, the distribution is not as worrisome. It's probably why you're not seeing as much of a negative reaction for the market today. So January, February, to me, looks like they kind of cancel each other out for both the jobs report and the CPI report.
And it was interesting, Kevin, because pre-market, we did see some selling off, but then it seems as if they gauged what the Fed has already been telegraphing, saying, look, we're not going to base anything on just one print. We want to see at least some of these 3 to 6 month changes to show that inflation is consistently coming down. But what should investors be really focusing on within the report when they're trying to look at their portfolios and trying to avoid some of these knee-jerk reactions?
Well, I do think you're right to point out some of these 3 and 6 month changes. I think you have to look and take a little bit more of a zoomed out approach and maybe even go further than 6 months, because most recently in the 60 Minutes interview that Powell did after the most recent press conference, after the Fed decision, he actually started citing the 12-month change in things like core PCE. So I think, it's a little bit of a moving target in terms of what the Fed has been looking at specifically in this cycle, in this inflationary cycle. But it really is getting to the point of they're saying that you have to be more consistent in getting down towards their 2% target. So it doesn't seem like we're there yet. And I think that, as they've been telegraphing and as they've been telling us this entire time, they just need more evidence that we're getting closer to that point. It makes it a little bit harder when you have a relatively resilient job market with wage growth that has looked a little bit murky in the past couple of months, but is still hanging in there, at a hotter rate than they're probably that they're probably comfortable with. So if anything, the message hasn't really changed. It's really been the market that has been jumping around in terms of when it expects rate cuts to start and how many you're going to get this year.
So, Kevin, where does that put the Fed's first rate cut, if there is a rate cut this year, and how do you invest around it?
Well, I think that for the first cut, we've been saying it doesn't really matter necessarily as much when it is. It really matters more the context in which they're cutting. But, if I were to put an estimate on it now, probably, June seems fair. And I would say June with a couple of cuts following, maybe not at, every single meeting. And I think that's probably the better case right now, because if you think about an aggressive rate cutting cycle, which we've had 3 in the past, if you go back to the past 3 cycles that we've had in recent history, dating back to the early 2000s, they have been more aggressive in nature, notwithstanding the one that sort of preceded the pandemic, where it was a little bit gradual. But of course, the Fed had to go much more aggressive when we did have the pandemic and the associated recession. But I think that if you go prior to the early 2000s and you look at prior cycles where they have been slower in nature and they haven't been as aggressive, investing around that has actually been a little bit more favorable, at least for the U.S. stock market. So slower cutting cycles for the Fed tend to be more consistent with better equity market returns and vice versa. You get a much more aggressive drawdown when the Fed is slashing rates and, getting close to the zero bound. Certainly in the case of the financial crisis, getting to the zero bound. Same thing with COVID. So I think you have to sort of keep in mind the context in which they're cutting, not necessarily when the cut arrives.
And Kevin, I want to refer to a phrase that you mentioned in your note here: duck markets, calm on the surface, paddling like the Dickens underneath. So essentially everything calm on the top, little bit of, fluster underneath there. And you say that you're seeing this in the stock markets as well as the labor market as well. With that in mind then, what are some of the sectors that you like, being that you're seeing this calm, but some of this froth underneath as well?
Yes, and a tip of the hat to Michael Caine for that quote that we included. But I think that, from a sector perspective, in terms of our model and what we have as an outperform, it leans more cyclical in nature. So we've got energy, materials, and financials in the outperform category. And conversely, in the underperforms, you've got real estate and discretionary. Both of those still skew a little bit more cyclical in nature, but for different reasons. Real estate, maybe no surprise around some of the commercial real estate concerns in the broader economy, but also for consumer discretionary, you have a pretty significant sort of concentration risk with Tesla as a huge part of that index, that sector, weighing on performance a lot, in addition to what we expect to be kind of this gradual softening in consumption over the course of the year. Nothing sinister, but something more gradual. Our focus has been a lot on factors, as both of you likely know, in talking with my boss, Lizanne Saunders. We've been a lot more focused on factor-based investing because, you can look for high-quality metrics like strong free cash flow yields and high cash positions on balance sheets and strong relative profit margins, and you can find it in any sector. So it exists in energy, it exists in tech, it exists in consumer discretionary. It's just when you look at the weight of all of those, they tend to skew a little bit better in the outperforming sectors that I mentioned. But we would encourage investors, up and down the cap spectrum to look at higher quality parts of the market because that's really where you've found the most consistent outperformance.
Well, Kevin, always great to get your take here on Yahoo Finance. Kevin Gordon, Charles Schwab, Senior Investment Strategist. Thank you so much.